Hey, Talfa here. In this video, I'm going to talk about pros and cons of bank financing. What does it mean? What are alternatives and what to do with that? Why it's important? Well, because there are many misconceptions and patterns I hear from founders around all the different countries in the world. They don't get it right. Some are afraid of banks, some are over leveraging, some are just skipping that part and just bootstrapping, raising equity. And because of that, they're missing the main ingredient. It's return on equity. With bank financing, you can get more returns on your capital. And there are many options on the table. So I'm not saying you need to borrow money from banks. I'm just saying that it's good that you have many options for you available for your business. Why me? Well, I used to work for Ernst & Young and it was a CFO of a big holding company. We had 50 million assets on or across 70 different companies. I'm an entrepreneur for the last 10 years. I'm developing different companies in fintech, wholesale, retail. I had a total of 36 ventures. Some I sold, some were lost, some went bankrupt. And mostly I was doing in the lending business for 20 years. So I know the numbers. I can do that when my eyes closed while drinking my mate. I work in bankruptcy and addiction. I share that with another of my videos. Up to date, I have fundraised more than 100 million euros for plus 1,300 companies. And my mission is to spread knowledge that I know how to grow your business using bank money. That's it. That's easy. My mission. There are 600 million entrepreneurs around the world, also including you watching this video. So I really know that it helps you to grow your company. Why? Because there's a big problem. There are many banks and there's a funding gap. Most of the founders don't know how to get money. This is what we see in the statistics. Banks were there for 4,000 years. They will be there while you're here. And there are too many banks. We don't know how to swim to them, how to get to the island. And this is how we just see that. We receive high rejection rates when we apply to the banks, and then the emotions kick in and we just, don't want to apply anymore, don't want to work with the bank money. This is just how the mindset works. So there's a wrong mix also in regards to the equity and debt. Again, Europe has money, so the capital is there, loan to deposit ratios are enough. So there's a myth that banks don't have money. They have it. Rates are going down. At the point of the video, Euribor is going down and billions on top in the market, and we're still lagging behind the US and other developed countries, developed liquidity countries, right? So we have money sitting there on the table. We as founders we need to get it in our pockets and to grow a company. So what's the agenda for this video? First, what are the pluses of bank funding? And when I talk about banks, I'm talking about all alternative lenders, banks, alternative financing institutions. So every institution that has a license, it's regulated and it's lending money as its core business. This is important. This is what I mean by banks. And funding is the process when you get the money in your bank account of the company. So I'm talking about business only, no private lending here. Second, we'll talk about minuses of the bank financing because there are always pluses and minuses. If you find a person that says and talks about only pluses, that person is not professional. So there will always be pluses and minuses. It's like when you get born, it's a plus, and then you have a guarantee that you will die, right? So we always have these pluses and minuses, the sun and moon, etc. And then we're going to talk about what are the alternatives of the bank financing. So maybe you go to a bank, maybe you go to a private investor, maybe you bootstrap, maybe you can find some other ways. Actually, there's more to that. Okay, so what is the first pro of the bank financing? What's the cheap money? If you compare bank money to VC, to expensive capital, to borrowing from friends, family, fools, bank money is the cheapest money you can get on the market. If you issue bonds, you'll pay more. If you go to private investors, most probably they'll charge you more because they're pricing the risk in a different way. But the bank money is the cheapest money you can get on the market, period. Second, you don't give out any shares. So when you do the business and you work with the bank financing, they don't take shares. Even friends, family, fools for that sake, and private investors should not be taking shares for lending you the money. Yes, you can have convertible bonds. Yes, you can have some kind of equity kicker, maybe for some future. But in the fundamentals, you don't give any shares to the company that is lending money to you. This is very important for us as founders to retain the control. First is about the control of the company. Second is about the share, the voting power, the shares, and the distribution of the dividends, of the profit that you get. Plus, it's much easier to sell the company. You don't need to have these minority shareholders or big partners to understand and have these negotiations, what we do with the company, how we grow, when do we sell it, right? So you don't give any shares to the bank. Third, you have predictable payment terms. So you have a schedule, 1, 2, 3, 4, 5, 10 years. You have a monthly, quarterly payment. You have a specific list of covenants or criteria that need to follow. You have a specific reporting. So actually bank helps you to structure the process of doing that, and it's much easier to know when and what you are paying. So it gives a lot of structure. Now the fourth one is that you get more liquidity. So banks usually have dozens of financial products for business, with credit line, factoring, capex financing, purchase financing. It could be different ways. In our company, Offerta Finance, we have a list of, I think, 150 different financial products that are available there for business. I don't know them all from my head. All the time we're using AI tools and that are searching in a big list of different financial products. And then the naming of the product depends on the country and the bank you're working with. So there are many of these misconceptions. But in essence, you have access to bigger range of products and you have access to more liquidity, because the more you grow, the bank can give you more money. Actually, it's much harder to get loan than to retain it and to increase the amount that is lent to you. And fifth, you get more discipline. So the bank helps you to organize your finances, to do your homework. This is what we talk about in our workshops when you work with founders one-on-one or in the groups. The biggest part is like getting rid of these negative patterns and making sure that the founders get the math right, and then we do the homework. This is the part that nobody wants to do. Founders don't like to do that. They're afraid doing that because of the old patterns, but when they do, they feel better. Because when applying for a bank gives you a list of homework to be done. If you get rejection from a bank, there are always reasons why, so go and make your homework. If you get approval, then it means that you got your homework right. So bank is a friend that helps you to do your homework, to prepare what needs to be done in the company. Again, just a reminder, banks are here for 4,000 years and they will be still here for the next 4,000 years. Don't expect them to disappear, even with all the crypto stuff. And the last, it's a good credibility signal. So usually banks is like a second pair of eyes. So imagine you're making business and you want to have a second opinion. Your accountant, maybe. Your CFO, maybe at a certain stage you don't have a CFO, or CFO has a limited opinion on what to do with the company. She works more with the reporting and the budgeting, not with the financials. So you need to have a second opinion. And banks and people working in banks, their rational thinking is more developed than their emotional thinking. In that sense, they're more conservative. So it's always good to have a second opinion from banks. And it gives a credibility signal. When I was raising my equity from one of my companies, having a bank saying yes is a strong, good sign. So always remember that. And this is the case. I had a customer, he called me, said, well, I need money. And in his case, that was very good because first, he was in business more than 5 years. Second, he has standardized procedures. He went through many cycles of, he was, I think, wholesale of wooden logs. And so he standardized, he went through many cycles. So he's pretty much stable in what he's doing. He's not A/B testing and hypothesis testing it on a weekly basis. He's just producing, right? He's predictable, stable cash flow. So he has a cash flow plan and more or less it goes with the plan and actual and the fact. He has a clear why. He needed money to buy out the shareholders. And then when he bought them out, he wanted to take the money to refinance the money he got from a bank that was in 2-act, right? So, and he had 6 months timeline to get loan from a bank because it takes time. I'll usually say from 2 to 6 months. Sometimes you can do it in 1 month, sometimes you can do it in 12 months. It depends on your situation and the size, but it takes time. So in his case, it was good to borrow money because he had all the criteria in the place. So it depends. Okay, now we go for the minuses. So what's the minus? Number one, you give personal guarantees. Depending on how big you are, in which country, which bank, if it's a state-owned bank, most probably they will have a limited or no personal guarantees demand from you. In a regular case, if you're just starting out or your first few years in the business, they will ask you to give out the personal guarantees, and that's a choice, but mostly you just give them out for a bank. This is number one. Number two, they ask for collaterals. Banks don't want to risk that much They don't want to take the first risk of your business. Usually it's your equity, then it's investors' equity, and only then they're banks. So they're just thinking, okay, the guy's risking, I'm not, so I'm gonna be the first one if something bad happens, so I have a collateral. What kind of collateral do you have? Land, property, immovable property, invoices. So this is how banks are thinking. This is why they're there for many thousand years. So they're asking that, that's a minus. Why? Because if you don't have any collateral, it's very hard to get money. Next one, it's ongoing reporting. When you take money from bank, trust me, you need to spend time on that one, on sending reports, sending information, answering questions, making sure that you are aligned with the covenants. What is covenant? They can have some implications and restrictions on your business, what you can do and when you cannot. For example, it's a normal thing that you cannot borrow more money without the consent of the bank. So you need to be aware that it's a cost you pay. The next thing is that the complexity. Sometimes it's too hard to understand what kind of product you need from a bank. Even like if only 5 products, still it's very hard to compare them. And if you have a bad manager in the bank, then you're screwed. Because if the bank has many products and the manager's not right, then you're done. So it could be very hard to understand. And this is the pattern I see with the founders. If they don't understand something, there are 2 paths. One, they say, I want to understand fully, and then they go and grab the information. And second, they'll say, no. I don't understand, I will not go there. That's the choice, but you're missing out. The 5th point is that banks are not forever. Your current home bank could be a case it's not forever for you. For example, something changes in the law, some anti-money laundering rules or some other rules, and then the bank kicks you out, right? Or bank changes risk scoring or credit procedures, something else changes, bank kicks you out. Or bank has a limit for a credit product. You're growing quicker than the bank, you need to find another bank. If you need another product, we have a case for a customer that we helped the customer to get around 1 million euros for manufacturing line, but then the customer needed a credit line and the bank gave the credit line, but then the customer said, I have invoices, I'm gonna go for factoring, it's invoice financing, and bank says we don't have that product. So it's a very niche bank. So what we did, we helped customer to find financing from other financial institutions. So they're putting them together. So it means that if you apply to a bank, you need to keep in mind that at some point it could be that you'll be departing or finding another financial institution because there are limits and many implications. So this is my case. So we had a steel business. This is where I lost my €1 million. Why? Because the margins are lower than the cost of capital. So the money was much expensive than the margins we made on the business because we shifted from the retail to wholesale. Second, the lifetime cycle, the long-term cycle of the business became longer than the money cycle. For example, we borrowed money for 3 months, for 6 months, but our cycle from buying steel to selling steel was 4 months. You can see immediately, I borrow money for 3 months, my cycle is 4 months, something happens with the cycle, 5-6 months, it's double the time that I borrowed the money. What happens in 90 days? Creditor calls me and says, Arthur, where's my money? I have a plan for 3 months, and then either I need to refinance that loan or say something or prolong it. I mean, it's extra problems for me. Next one is unpredictable cash flow. In that type of business, it really was unpredictable. It was seasonal. First the COVID hit, then the Ukrainian-Russian war started. So in the Baltic states, we're kind of connected to that. So a lot of unpredictable cash flows. It's not the best idea to borrow money. Change your business model. We're changing from retail to wholesale. Margins dropped, a lot of internal frictions, and it's really hard to predict the business. And banks don't lend. So we applied for a few banks. We got a few loan amounts from banks. That's it. Banks said, no, you have not enough equity. You need to increase your equity. You need to work for 1-2 years, and then we will see. Because when the banks are seeing high risk in the industry, let's say the war started, the steel price went up, first COVID, then the war, they say, okay, we're sitting here just waiting for the situation to resolve. This is what banks said. And what we did, we borrow money from private investors. We're very high interest rates. And you can find in my YouTube video, this is how I went bankrupt. Minus €1 million, this is what I end up in my bank account. Okay, what are the alternatives to a bank funding? Actually, we made a research, so we asked 200 plus customers, what do you do? Like, okay, you go for a bank, but what are the alternatives when you need money? It could be different needs why you need money, but what's the main reason why you need money? And again, what do you do when you need money? So 30% said, I'm just bootstrapping. I just put my equity in my company. I can lend money to my company. This is how founders interpret. They invest in their company, or they can increase the share capital, pay out, and they increase it. They just put their own money in a company and then it grows. The second is we bootstrap, we grow without equity injection, but we find some ways how to grow. For example, I use money to hire people, then the people make more sales, and with the more sales, I have more revenue, more profit. This is how I grow. Then 23% that raise equity from angels, VCs, private. Again, this was or research or questionnaire. I'm not saying these are the numbers across all the industries. In some industries, you just only go for VC, private, and then you add bank financing. For example, if I would start a SaaS business or an e-commerce shop, most probably I need VC, and only then I'll go for bank money for after maybe 2-3 years in the business. Then 21% they just call their customers. In a B2B, it's very common. Then you call and ask, hey, can you pay quicker? And this is how you get the money in your business. Then you can do the other side of the balance sheet table. You can call your suppliers and say, can I pay you later? Sometimes it goes with a cost. They say, okay, can you buy me? So how to tackle it? You can buy more. This is what we did in wholesale. I say, look, man, I cannot pay you today, but can you give me more amount, or I pay you 20% for an invoice, but I need more amount. I need more goods. Can you sell me more? Maybe a little bit more expensive. Again, everything costs money. Then you can borrow from alternative financial institutions, not from banks, from other alternative lenders. They're more costly, but they're quicker to go. You can borrow from friends, family, fools. This is how it's called. It depends on your situation. Sometimes it's good, sometimes it's bad, but people do that. We all have this friend of, let's say, John, or Boris, who lends money at high percent, right? Then some sold inventory to get more cash, and then you just reject the deal and grow the opportunity. But actually there's another one, and it's called money-making models. I like it. Alex Hormozy, he's one of my mentors. What he says in the book, if you don't have the book, buy the book. It says that you can change the business model, and it's self-fundable, self-sustainable. You can grow your company with the advance payments from your customers by changing the business model. This is what also can be done. And I like doing that because you don't need to raise any external funding. You just change the business model. Of course, it requires, I think, more skill, more diligence, and more input from your side. So the final word from my side, bank money is an amplifier. It amplifies your current situation. If unit economics is good, business is running, it's stable, it just amplifies what you have. If it's bad, it amplifies what's bad. This is how we lost our money in steel business. So at some stage, I think debt funding is forbidden for a company to go because it just make it worse. I mean, you can apply, it gets rejections, it get a homework, and then you do the homework and you can go back. But sometimes it's just forbidden, even though the bank is saying, yes, we can lend you. You have a term sheet on the table. But if inside you see that something's wrong, your business, you're not sure if you can, pay back, then I'll say don't take the money. But at some stage, it's must have. Just to look at the top companies that go to IPO, if they have any bank financing. Yes, they do, because otherwise investors will not invest in new money. They need return on equity. So this is very important. Okay, so thank you very much for watching this. What's next? You can download my blueprint. This is what we made for all the founders out there. This is the ultimate funding guide. You just download, you read it, and you can prepare yourself for getting bank financing. Even though you don't need it now, you can be ready and know information. So in the future, when you need it, you can get that, and you can watch one of the webinar masterclasses I run before, how to prepare debt funding strategy and our 5-step debt funding blueprint. So this was amazing, and actually you can check on the website many things we do for founders, for businessmen around the world, to increase their probability of succeed and growing quicker with the debt funding. This is what we do on this channel. So my name is Arthur Jasari. Thank you very much for watching, and have a nice day.